If you've ever wanted passive income that shows up like clockwork, there's one simple truth most investors miss. Monthly dividend payments feel completely different than quarterly ones. Not because the total return is different, but because regular cash flow changes how you think about investing. When money arrives every 30 days instead of every 90, you start to see your portfolio as something that works for you right now, not just someday in the future. In this video, I'm going to show you the results of testing 9 popular dividend ETFs, how 8 of them left me waiting months between payments, and why only one delivered cash every single month without fail. We'll break down real performance data, compare dividend consistency across all 9 funds, and I'll show you exactly how to structure a portfolio that pays you 12 times a year instead of 4. And at the end, I'll reveal a simple 3-fund combination that can generate monthly income starting with as little as $100. But before we jump in, make sure you hit that subscribe button and turn on notifications so you never miss a breakdown like this one. Now let's talk about why monthly dividends matter more than most people realize. Most investors focus entirely on total return and completely ignore payment frequency. They'll choose an ETF that pays 4% annually in quarterly chunks over one that pays the same 4% monthly. On paper, the math looks identical. 4% is 4%, right? But in real life, the experience is completely different. When dividends arrive every month, you can actually use them. You can reinvest faster, cover small expenses without touching your principal, or simply feel the momentum of your portfolio working consistently. Quarterly payments force you to wait. You get a chunk in March, then nothing until June, another payment in September, then a long wait until December. That 3-month gap doesn't feel like progress. It feels like waiting, and waiting kills momentum. Monthly payments create rhythm. Every 30 days, cash shows up. Every 30 days, you're reminded that your investment is doing its job. Every 30 days, you can make a decision, reinvest it, spend it, or let it accumulate for something specific. That frequency changes behavior. It keeps you engaged with your portfolio instead of forgetting about it for months at a time. And that consistent engagement is exactly what makes long-term investing feel sustainable instead of abstract. This is why I decided to test 9 dividend ETFs side by side, tracking not just their yields and returns, but how often they actually paid me. I wanted to see which ones delivered monthly income and which ones made me wait. The results were more revealing than I expected. The first ETF I tested was VYM, the Vanguard High Dividend Yield ETF. This fund is incredibly popular. It holds over 400 U.S. stocks that pay above average dividends, focusing on quality companies with solid fundamentals. The expense ratio is low at just 0.06%, and the yield usually sits around 3%. The performance has been steady over the years, and it's a reliable choice for long-term dividend growth. But here's the problem. VYM pays quarterly. I received dividends in March, June, September, and December. 4 payments total for the entire year. That means 3 full months of silence between each check. When I was looking for monthly income, VYM didn't deliver. It's a great fund, but it doesn't solve the problem of consistent cash flow. The second ETF was SCHD, the Schwab U.S. Dividend Equity ETF. This one gets a lot of attention in the dividend community, and for good reason. It tracks an index of high-quality dividend stocks with at least 10 consecutive years of dividend payments. The expense ratio is incredibly low at 0.06%, and the yield typically runs between 3 and 3.5%. The fund has delivered strong total returns, and its focus on dividend aristocrats makes it a solid long-term hold. But just like VYM, SCHD pays quarterly. I got 4 dividend payments spread across the year, with long stretches in between. Again, it's a fantastic fund for dividend growth and stability, but it doesn't create the monthly rhythm I was testing for. The third fund I tested was DGRO, the iShares Core Dividend Growth ETF. This ETF focuses on U.S. companies with a strong track record of growing their dividends over time. It holds a diversified mix of large and mid-cap stocks across multiple sectors. and the expense ratio is low at 0.08%. The yield is a bit lower than VYM or SCHD, usually around 2 to 2.5%, but the dividend growth rate is higher. Over time, that growth compounds nicely. However, DGRO also pays quarterly, 4 times a year, spread out evenly. I received payments, but not the monthly frequency I was looking for. It's built for long-term dividend growth, not short-term cash flow consistency. The fourth ETF was NOBL, the ProShares S&P 500 Dividend Aristocrats ETF. This fund is designed around one simple idea. It only holds companies that have increased their dividends for at least 25 consecutive years. That's a high bar, and it results in a portfolio of some of the most reliable dividend payers in the market. The expense ratio is 0.35%, which is higher than the previous funds, but still reasonable given the quality of holdings. The yield typically sits around 2%, which is lower than average, but the consistency and growth are excellent. Yet once again, NOBL pays quarterly, 4 dividend payments per year. It's a strong fund for stability and long-term compounding, but it doesn't provide monthly income. The fifth fund I tested was VIG, the Vanguard Dividend Appreciation ETF. This one focuses on companies with a history of increasing dividends, but it doesn't require the 25-year track record that NOBL does. That opens the fund up to a broader range of growth-oriented dividend payers. The expense ratio is low at 0.06%, and the yield usually runs around 1.8 to 2%. VIG has delivered solid price appreciation over the years, and it's a great choice if you want dividend growth combined with capital gains. But like all the others so far, VIG pays quarterly, 4 times a year. Consistent within that structure, but not monthly. I received my dividends on schedule, but the gaps between payments were still there. The sixth ETF was HDV, the iShares Core High Dividend ETF. This fund takes a different approach. Instead of focusing on dividend growth, it targets high current yield. It holds around 75 U.S. stocks selected for their ability to pay sustainable high dividends. The expense ratio is 0.08%, and the yield typically runs between 3.5 and 4%, which is higher than most of the funds I tested. The downside is slower dividend growth and less price appreciation. But even with that higher yield, HDV pays quarterly, 4 payments per year. I got larger individual payments compared to some other funds, but I still had to wait 3 months between each one. The seventh fund I tested was SPYD, the SPDR Portfolio S&P 500 High Dividend ETF. This ETF focuses on the 80 highest-yielding stocks in the S&P 500, rebalanced twice a year. It's a simple, concentrated approach to high-yield investing. The expense ratio is low at 0.07%, and the yield is impressive, often running between 4 and 5%. That makes it attractive for income-focused investors. However, the fund is more volatile than others because it leans heavily into sectors like real estate, utilities, and energy. And just like the rest, SPYD pays quarterly. I received 4 dividend payments throughout the year, each one solid in size, but spread out across the calendar. The eighth fund was DIVE, the Global X Super Dividend US ETF. This one is designed specifically for high current income. It holds 50 of the highest-yielding U.S. stocks, weighted equally. The expense ratio is 0.45%, which is higher than most broad market dividend ETFs, but the yield is also much higher, typically between 5 and 6%. The trade-off is more volatility and less dividend growth. The fund prioritizes current income over long-term appreciation, and even with that high yield, DIV pays quarterly, 4 times a year, with 3-month gaps in between. I got bigger individual checks, but not the monthly rhythm I was testing for. By this point, I had tested 8 dividend ETFs. Every single one of them paid quarterly. Some had higher yields, some had better dividend growth, some had lower fees, but none of them gave me monthly income. That's when I tested the 9th fund. And this one changed everything. The 9th ETF I tested was DIVO, the Amplify CWP Enhanced Dividend Income ETF. Right away, this fund operates differently. Instead of passively tracking an index, it's actively managed with a focus on high-quality dividend-paying stocks combined with a covered call strategy. The covered call approach generates additional income on top of the dividends, which allows the fund to pay distributions monthly, not quarterly, monthly. The expense ratio is higher at 0.55% because of the active management, but the yield makes up for it. Devo typically yields between 5 and 7%, depending on market conditions, and those payments arrive every single month, 12 times a year. No waiting, no 3-month gaps, just consistent monthly cash flow. I received a payment in January, another in February, another in March, and so on. Every 30 days, income showed up. That consistency completely changed how I interacted with the fund. I could plan around it, I could reinvest faster, I could see progress every month instead of every quarter. Devo became the only fund in my test that delivered true monthly income, and that alone made it stand out from the other 8. But monthly payments are only part of the story. The next question is whether Devo actually performs well enough to justify holding it long-term. Let's break down the details. Devo holds around 25 to 35 individual stocks at any given time, focusing on large-cap companies with strong fundamentals and solid dividend histories. The portfolio includes names from sectors like technology, healthcare, financials, and consumer staples. The fund doesn't chase the highest yields. Instead, it looks for companies that can sustain and grow their dividends over time. That focus on quality keeps the portfolio stable even during market turbulence. On top of the dividends, Devo uses a covered call overlay strategy. In simple terms, the fund sells call options on a portion of its holdings, which generates extra income. That income gets distributed to shareholders as part of the monthly payment. The trade-off is that covered calls can cap some of the upside during strong rallies, but they also provide extra income during flat or declining markets. It's a strategy designed for income, not maximum price appreciation. Over the past few years, Devo has delivered monthly distributions that have remained relatively stable, even during periods of market volatility. The yield has stayed in the 5 to 7% range, and the fund has maintained its monthly payment schedule without interruption. That reliability is exactly what income-focused investors need. When you combine the dividends from quality stocks with the income from covered calls, Devo creates a cash flow engine that works every single month. It's not the highest-yielding fund, it's not the lowest-cost fund, but it's the only one in my test that paid me 12 times a year without fail. Now let's talk about what monthly income actually does for a portfolio. When dividends arrive every month, reinvestment happens faster. Instead of waiting 90 days to put cash back to work, you can reinvest every 30 days. That means more frequent purchases, which smooths out your entry points and reduces the impact of market timing. Over time, that faster reinvestment compounds into noticeably better results. Monthly income also makes budgeting easier. If you're using dividends to supplement living expenses, monthly payments align perfectly with monthly bills. You don't have to save up quarterly payments or plan around irregular cash flow. The money arrives on a predictable schedule, which makes financial planning simpler and less stressful. There's also a psychological benefit. Monthly payments keep you engaged with your portfolio. Every time a dividend hits your account, you're reminded that your investment is working. That regular feedback loop reinforces positive behavior and makes it easier to stay consistent over the long term. Quarterly payments, by contrast, can feel distant and abstract. You might forget about your portfolio for months at a time, which weakens your connection to the process. Consistency matters in investing, and monthly income creates consistency in both cash flow and mindset. But here's the thing, you don't have to choose just one ETF. In fact, combining funds strategically can give you even better results. Let me show you how. If you want monthly income but also want the benefits of low-cost index funds and dividend growth, you can build a simple 3-fund portfolio that delivers cash flow every single month. Here's how it works. Start with Devo as your monthly income core. Allocate 30 to 40% of your portfolio here. This gives you consistent monthly payments and stable yield. Then add VYM or SCHD as your dividend growth layer. Allocate another 30 to 40% here. These funds provide lower current yield, but higher dividend growth and lower fees. They'll increase your income over time and add diversification. Finally, add a total market index fund like VTI or a growth-focused fund like VUG for capital appreciation. Allocate the remaining 20 to 30% here. This balances your portfolio with broader market exposure and long-term growth potential. With this structure, you get monthly income from DIVO, dividend growth from VYM or SCHD, and price appreciation from VTI or VUG. You're not relying on a single strategy. You're blending income, growth, and diversification into one cohesive portfolio. And because DIVO pays monthly, you'll still receive cash flow 12 times a year, even though the other funds pay quarterly. That monthly rhythm stays intact. Let's walk through a simple example to see how this works in practice. Imagine you have $10,000 to invest. You allocate $4,000 to DIVO, $4,000 to SCHD, and $2,000 to VTI. DIVO yields around 6%, so that $4,000 generates roughly $240 per year, paid monthly. That's $20 every month. SCHD yields around 3.5%, so that $4,000 generates about $140 per year, paid quarterly. VTI yields around 1.5%, so that $2,000 generates about $30 per year, also paid quarterly. In total, your $10,000 portfolio generates $410 per year in dividends. That's a blended yield of 4.1%. But more importantly, you're receiving $20 every single month from DIVO, plus quarterly payments from SCHD and VTI. The monthly payments keep cash flowing consistently, while the quarterly payments add extra income throughout the year. As your portfolio grows, the monthly income from DIVO grows with it. If you reinvest dividends and add regular contributions, that $20 per month can grow to $50, then $100, then $200 or more. The consistency of monthly payments makes it easier to track progress and stay motivated. And because SCHD and VTI are focused on growth, your portfolio also benefits from rising dividends and price appreciation over time. This isn't a get-rich-quick strategy. It's a build wealth steadily strategy. The kind that works in real life, with real money, over real decades. Now let's address some common concerns about monthly dividend funds like DIVO. The first concern is the higher expense ratio. At 0.55%, DIVO costs more than passive index funds like VYM or SCHD. That's true. But the higher yield and monthly payment structure can justify the cost if income is your priority. The key is understanding what you're paying for. You're paying for active management, a covered call strategy, and monthly distributions. If those features align with your goals, the expense ratio becomes a reasonable trade-off. The second concern is the covered call strategy. Some investors worry that selling call options will cap their upside during bull markets. That's also true. Covered calls can limit gains when stocks rally sharply, but they also generate income during flat or declining markets, which provides downside protection. If your goal is maximum price appreciation, DIVO might not be the best fit. But if your goal is consistent income, the covered call strategy enhances cash flow without adding significant risk. The third concern is sustainability. Can DIVO maintain its monthly payments over the long term? So far, the answer is yes. The fund has been paying monthly since its inception, and the distributions have remained relatively stable. The combination of dividends and covered call income provides a dual source of cash flow, which makes the payments more resilient than funds that rely on dividends alone. Of course, past performance doesn't guarantee future results, but the structure of DIVO is designed specifically to support consistent monthly income. Another common question is whether monthly dividend ETFs are better for retirees or younger investors. The truth is, both can benefit, but for different reasons. Retirees often need reliable cash flow to cover living expenses. Monthly payments align perfectly with monthly bills, which makes budgeting easier and reduces the need to sell shares. For retirees, Devo can serve as the income engine of a portfolio, providing predictable cash flow without disrupting the overall asset allocation. Younger investors, on the other hand, benefit from monthly dividends through faster reinvestment. Instead of waiting 3 months to put cash back to work, they can reinvest every 30 days. That accelerates compounding and smooths out market volatility. For younger investors, Devo can serve as the income layer of a diversified portfolio, complementing growth-focused funds and total market index funds. The key is matching the strategy to your stage of life. If you need income now, monthly dividends are ideal. If you're building wealth for the future, monthly dividends still help by speeding up reinvestment and keeping you engaged with your portfolio. Either way, the consistency of monthly payments adds value that quarterly funds simply can't match. Let's also talk about tax efficiency, because that's a factor many investors overlook. Dividend income is taxable, and the frequency of payments doesn't change the tax treatment. Whether you receive dividends monthly or quarterly, you'll owe taxes on the income in the year you receive it. However, the source of the income does matter. Qualified dividends, which come from U.S. stocks held for a certain period, are taxed at lower capital gains rates. Non-qualified dividends and income from covered calls are taxed at ordinary income rates. Devo's distributions include both qualified dividends and income from covered calls, which means a portion of your payments will be taxed at ordinary rates. That's something to keep in mind when planning for taxes. If you hold Devo in a tax-advantaged account like an IRA or Roth IRA, the tax impact is minimized or eliminated entirely. That makes monthly dividend funds like Devo especially attractive in retirement accounts, where you can enjoy the consistent cash flow without worrying about annual tax bills. In taxable accounts, the tax treatment is less favorable, but the trade-off is still worth it if monthly income is a priority. Just make sure to factor in the tax implications when comparing Devo to other dividend funds. Now let's look at some real-world scenarios to see how monthly dividends can fit into different investment strategies. Scenario 1. You're a retiree with a $500,000 portfolio. You allocate $200,000 to Devo for monthly income. At a 6% yield, that generates $12,000 per year, or $1,000 per month. You allocate another $200,000 to SCHD for dividend growth and stability. At a 3.5% yield, that generates $7,000 per year in quarterly payments. The remaining $100,000 goes into VTI for broad market exposure and price appreciation. At a 1.5% yield, that generates $1,500 per year. Your total annual dividend income is $20,500, which is a blended yield of 4.1%. But more importantly, you're receiving $1,000 every single month from Devo, plus quarterly payments from SCHD and VTI. That monthly income covers basic expenses, while the quarterly payments add extra cash for discretionary spending or reinvestment. Your portfolio is diversified, income-focused, and aligned with your retirement needs. Scenario 2. You're a younger investor with 10 years of consistent contributions ahead of you. You start with $5,000 and allocate $2,000 to Devo, $2,000 to SCHD, and $1,000 to VUG. Every month you add $300 to your portfolio, split across the 3 funds. Devo provides monthly dividends that you reinvest immediately. SCHD and VUG provide quarterly dividends and long-term growth. Over 10 years, your monthly contributions total $36,000. With reinvested dividends and market growth, your portfolio could grow to $70,000 or more, depending on market conditions. The monthly dividends from Devo keep you engaged with your portfolio and speed up compounding through frequent reinvestment. By the time you reach year 10, your monthly dividend income from Devo alone could be several $100s, and that income continues to grow as your portfolio grows. The combination of monthly cash flow and long-term growth gives you both immediate feedback and future wealth. Scenario 3. You're an income-focused investor who wants to live off dividends without selling shares. You build a portfolio with 50% in Devo, 30% in SCHD, and 20% in HDV. This structure maximizes current income while maintaining some dividend growth potential. With a $100,000 portfolio, you might generate $5,000 to $6,000 per year in total dividends. Divo provides monthly income, while SCHD and HDV provide quarterly payments. You live off the dividends without touching your principal, and over time, the dividend growth from SCHD helps your income keep pace with inflation. This strategy isn't about maximum returns. It's about sustainable income that you can rely on month after month, year after year. The monthly payments from Divo make the strategy feel real and tangible, which keeps you motivated to stay the course. So, let's go back to the original question. Out of 9 dividend ETFs, which one paid me every single month? The answer is Divo. Every other fund I tested paid quarterly. Some had higher yields, some had lower fees, some had better dividend growth, but only Divo delivered cash flow 12 times a year without interruption. That consistency is what makes it stand out. If your goal is monthly income, Divo is the only fund in this test that solves the problem directly. It's not perfect. The expense ratio is higher, the covered call strategy caps some upside, and the tax treatment is less efficient in taxable accounts. But if you value consistent monthly cash flow, those trade-offs are worth it. Divo does exactly what it's designed to do. It pays you every single month. Now, if you want to take this strategy further, here's what I recommend. Start by deciding how much of your portfolio you want dedicated to monthly income. If income is your primary goal, allocate a larger percentage to Divo. If you're balancing income with growth, keep Divo as one layer in a diversified portfolio. Next, consider pairing Divo with 1 or 2 low-cost dividend growth funds like SCHD or VYM. This gives you monthly cash flow from Divo and long-term dividend growth from the other funds. Finally, add a total market or growth-focused fund like VTI or VUG to round out your portfolio with broad market exposure. This structure gives you income, growth, and diversification all in one package. And because Divo pays monthly, you'll still receive cash flow every 30 days, even if the other funds pay quarterly. That monthly rhythm keeps you connected to your portfolio and makes the investing process feel more active and rewarding. One last thing I want to mention, the power of monthly dividends isn't just about the money, it's about the mindset. When you receive income every month, investing feels less abstract. You're not waiting years to see results. You're seeing progress every 30 days. That regular feedback loop changes how you think about investing. It makes the process feel real, tangible, and sustainable. Over time, that mindset shift leads to better decisions, more consistency, and stronger long-term results. Quarterly dividends work fine for many people, but monthly dividends work better for those who value frequency and engagement. If that sounds like you, Divo is worth serious consideration. It's the only fund in my test that delivered monthly income without compromise, and in a world where most dividend ETFs pay quarterly, that makes it truly unique. If you want to see how a single dividend growth fund can turn small weekly investments into serious monthly income over time, click the video on your screen. I break down the exact fund, the numbers, and the strategy step by step.